What is founder investor fit and how do you achieve it to make sure that you get the right investor for you? But there's a deeper problem that occurs. So many founders think that they can pick their investor up front, and there are so many different types of investors, they don't know what they're picking from, and it can become a confusing mess. Therefore, in this video, I'm going to walk you through how you need to be thinking about investors as soon as you start raising capital. This is not something that you just put off till later on. Beggars can't be choosers. I'm going to be explaining this to you, but at the same time, you need to understand your parameters, what you're getting into, and what you expect to happen versus what will actually happen when you're raising capital, especially as an early stage startup. Before we continue, my name is Ed Kang. If we met before, welcome back to my channel. As always, use the chapter markers to skip right to the good part of the video. If we haven't met, I'm a 7-time funded founder. Welcome to my channel. I've had 2 exits. That's just a fancy way of saying I failed a bunch of times to your benefit because I like to use YouTube videos like this and my entire channel to help founders, especially early stage founders raising early stage capital, avoid some of the catastrophic mistakes that I've made. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier. I'm also the Chief Strategy Officer for Startups.com. We help hundreds of founders every single week raise capital. I've got lots of content out there. If you're part of Startups.com, thank you so much for supporting us. Appreciate you being part of the community. While everyone's here, like, comment, subscribe. Check out Startups.com. If you don't know about Startups.com, let me know what you think. Would love your comments. Let's jump into Founder Investor Fit. This video is part of my CFXO system, which stands for Chief Funding Execution Officer. It's a system that I created to help any founder at any stage raise capital, but it's especially important for early stage founders to get into the system of raising capital. If you're already following along and you're already implementing CFXO into your company, as all my startups in my portfolio, I want them to do, we are at this stage, Founder Investor Fit. It's right there in the middle. And if you want more information, this entire tool and everything about CFXO is available for free to download in the description of this video. So go download the canvas, get access to all the resources and the newsletter, and we'll set you up and we'll help you become the CFXO and raise funding for your company. I have many founders come to me and they say, Ed, I just want a particular type of investor. I want them to be smart. I want them to be engaged. I want them to believe in our mission. And I want that investor before they even talk to any investors. And I have to pop their bubble and say, you know what? Beggars can't be choosers. You need to go out and access as many opportunities to get an investor to the table as possible, and then you can decide. The best thing that you can do is look for optionality. Go and find an investor, get them interested, get them attracted to you, and get more of them, and then you can decide. But if you're in a situation where you only have one investor, let's say an angel, willing to take a risk on your company because you're early stage, you are not going to be able to put demands on there. And on top of which, there's a way that you need to think about how you're going to negotiate them to even decide whether you want to bring them onto your cap table. Because I know many founders who've been given an early stage investment offer, and it has gone on to be toxic. It's killed their cap table, killed their ability to raise subsequent financing, and put so much pressure because there are all these terms that have created a toxic situation where the startup cannot possibly succeed. But I understand, as early stage founders, you're like, I'm going to take what I can get. But at the same time, you want to be balanced because you can't act entitled and say, I only want the investors that are going to fit me, the ones that I want. Where's the middle ground? What's the balance? Well, I'm going to give you a framework on how to evaluate that and how to determine whether that investor is right for you, whether you are going to achieve founder investor fit, because it's so important for the lifetime of your startup. Once you start raising capital and you take that first check in, you are always going to be raising capital if you're trying to build a unicorn, unless of course you're seed strapping, but that's for another video. You can check that out on my channel. This is an important thing to think about right now, and that's why I recorded this video. I want you to watch it through. How many times have you heard someone say you can have a good, fast, or cheap, pick 2 out of the 3? This is common in customer service. When I was running a family office and we had a retail location, I put these signs everywhere saying you can have a good, fast, or cheap, pick 2 out of the 3 in the retail locations, because you just can't get good, fast, and cheap altogether. It's not realistic. So if you want something good and fast, it's not going to be cheap. That's just the way that it works. If you want something fast and cheap, it's not going to be good. And if you want something good and cheap, it's not going to be fast. You got to wait some time for it. This is a great way to think about business models and customer service, but it also translates to how you can think about investors using a similar structure. Let's look at the 3 factors that you will take into consideration when figuring out founder investor fit. First is the size of the check. how much they're willing to invest. Next are the terms. What are the rules, the boundaries, the parameters that size of check brings, and whether or not it's going to be smart money. How much is that investor going to be involved with you in terms of the success of your startup? Because so many founders think, well, that investor is going to help me build my startup, but it just might not be the case. The investor might not have the capacity to do so. They're just going to give you money and then let you figure things out on your own, which is what investors are allowed to expect. But there are some investors who are willing to put in smart money, and they bring a lot more value for every dollar that they invest. Now, here's where founders make the mistake. They think, I'm going to get the size of check that I want for the terms that I want. I don't want to give up board seats. I don't want to give up control. I don't want to give up a lot of equity. And the investor is totally engaged. I'll pick up the phone and call them every single day or week. They're available to solve all my problems. They'll give me all their contacts. They're going to lead me to more capital or customers. That's what founders start to think, because obviously, that's the ideal investor for you. But the reality is, just like good, fast, and cheap, you are not going to be able to get all three in one investor. Here's where I want to talk about entitlement. Many founders make the mistake, and it drives investors away. I can sniff this out so quick, and it turns me off as an advisor. What do you think investors are going to think, especially when all these other founders are competing with you for their check? Founders think, well, I've built something, and in my mind, I know it's a winner. Of course, people should be investing in me. And many get super upset and say, I can't believe they passed on my trillion-dollar opportunity. Here's the reality. Investing in startups is a subset of private equity. VC is an asset class that's extremely risky. Now, it has asymmetric upside. You can literally 50, 100, 300x your capital, and that's where legends are born, and that's what gets everybody excited. If you were to put in $100,000 in Airbnb back in the day, you'd literally be a billionaire. But thinking something is a good idea in your head, of course you'd invest in yourself. You'll bet on yourself every day of the week, and showing an investor that you've de-risked it enough that they're willing to put their capital into you in such a risky investment, because 90% of startups fail, and less than 3% of startups that actually get VC funding will go on to be a unicorn. And if you looked at where they could put their money, they could easily put in the stock market and be making way more money than the average returns, even in a hedge fund. So if you got a high rate of failure, why would they invest in your startup versus just park their money into NVIDIA and 3x their money if you've been invested for the past decade? The only way investors will take a risk on you if the upside is there. Immediately, that eliminates your desire to have the terms that you want. That's really tough. Unless you're working on a baby unicorn in a rocket ship that's already going to the moon, it's gone parabolic as far as product market fit, investors will want their terms. A founder will rarely get the terms that they want, and it's always some type of compromise. And that's what this system is all about. This framework, this perspective, the way that you're going to approach founder-investor fit is all about compromise. So I want you to put yourself in that mindset that there's no ideal situation for you. It's all compromise. So imagine that you get the size of check that you want. You're trying to raise $1 million. Guess what? You're not going to get the terms that you want, and it's not necessarily going to be smart money. Let's say you do get that $1 million in an early stage. That investor may say, I want a board seat, and I want us to have an agreement that you don't get to make any decisions based on your salary, whether we pivot, hiring, bonuses, cap table, anything until it gets approved by me. And you're thinking to yourself, well, Ed, I'd never sign that type of deal. Really? Think about it just for a moment. If you don't have any other option, what are you going to say? You're going to say no to the only capital that's available to you. That's why you need to work on your startup and get optionality and get as many investors to the table as possible. And because of those terms, you're not necessarily going to get smart money. If they're locking you up and they get a lot of control because they put in the money that you want, they're not necessarily going to be on your side. I've seen horror stories, experienced them, where founders have told me behind closed doors, because they say, don't repeat that out there because we don't want to spread that information that you're one of these founders that tattles on investors, but it's not smart money. It's controlling money. They're not there to help you. In fact, I've seen some investors purposely tank a startup so they can put in more money and buy more of it or acquire it and move it into a different part of their portfolio. Yes, it has happened. And yes, I have dealt with investors that aren't bringing smart money. They brought toxic money in, and I've said yes to it, to toxic terms, and I've been in a bad situation. And that's where you don't want to be. How you solve for this is make sure that you don't need as big of a check as you're thinking. Work with smaller amounts and say, how about I run little experiments? That way you can limit the terms, the ownership, the dilution, and start to build your company, do great things with that little amount of capital, get a better valuation, and then the power dynamic is on your side. You can raise a much friendlier round. Now, let's say you get the terms that you want. You're saying, I want full control. You don't get that amount of capital. Then what's going to happen is probably the check size is not going to be there. the investor's going to say, well, then I won't invest as much and I can agree to your terms, the amount of equity that I'm going to get for this smaller size. And they're not going to be as interested in helping you out because there's not that big of an upside for them. That's why you as a founder have to figure out how to empathize with the investor and really everybody at your cap table and give enough of the company away where you don't lose your shirt, while at the same time, they're incentivized to be on your side, sit on your side of the table. It's the same thing with co-founders. You give a co-founder 5% of your company and you say, I want you to participate and give me 50% of the emotional capacity, all the stress that goes into building a startup. How incentivized do you think they're going to be? They're going to put their head on their pillow at night and grumble and say, wait a second, why am I breaking my back for 5% of the company? If they have single digits ownership of the company and they're just treated as an afterthought and you're not respecting them in terms of giving them terms that they're looking for, they're not going to be as motivated. And therefore, they're not going to be smart money. The less money that the investor puts in and the worse terms that they get, they're going to say, you go figure it out because I've gone as far as I'm willing to go based on your terms. Finally, let's get to the smart money. This is dream money for me. These are angel investors that might have been founders before and are willing to come in and work with you, literally be a partner and totally engaged. But by that mere fact, they may not give you the size of the check that you're looking for, and they might ask for more terms, better terms to participate as an advisor. They might want advisory equity. They want more incentive to say, I'm willing to put in my time, which is arguably worth more than their money, to do some heavy lifting for you, get some sweat equity going. So the smarter the money, the more you have to be used to negotiating something in addition for that effort that they're going to put in. Because not only are you getting financial capital, you're also getting intellectual capital. If there's one scenario I love the most, I would rather get smarter money in, take a smaller check size, and give better terms to incentivize that investor to come in. Nothing moves the needle better than a solid investor that gives you social proof to show to other investors. Let's say you got an angel that exited another company for $1 billion. They built a unicorn and they believed in what you're doing, and you have that validation to tell other investors, hey, I have the former CEO of this Fortune 500 company or this $1 billion exited company. That's going to say a lot. So in the beginning, smarter money is better money if I had my way. Remember, you're not going to get all three, but the last hill that I think you should die on are the terms. Now, let me be clear. This is not Shark Tank. When I say Shark Tank is predatory, I'm not kidding. It is literally a bunch of sharks, and those terms are the crappiest that I've ever seen. I know many founders who are trying to unwind their deals from Shark Tank, and it's been a nightmare. I've been their advisor. I've tried. I totally warn you that that is not reality. You would rather give up more of the pie to grow a bigger pie and to give the social signals out there that the pie is going to grow big and get the right investor in and give them the terms so you can continue to execute and raise that money, then fight over percentage points. Now, when it comes to other terms such as pro rata, maybe super pro rata, drag along rights, liquidation preferences, those are all things that you have to figure out and you have to navigate. And the more money they put in, the more those terms are going to come to the surface. And you want to make sure that you run every scenario and one of those skeletons doesn't come out of the closet and bite you on the tail at the worst possible time. But if I had to pick one of the three that I think you're going to have to compromise most on, it is the terms of the deal. Now, let's say you happen to luck out and you got the size of a deal and the terms that you want because you're building a unicorn. Most likely, that's going to be a fund that recognizes you and has a lot of money to deploy, a lot of capital to allocate. They got a ton of dry powder. Well, then that's not going to be smart money. They've got a bigger fund that they're going to be managing, and therefore you're not going to be able to walk into the office of A16Z. You're not going to be able to walk into Mark Andreessen's office and say, hey, can I just talk to you about some startups? Very rarely do the general partners go out and they give office hours. Can you talk to them? Unless you are really, really pushing it, unless you're that unicorn ready to happen and you're at the later stages raising later rounds. Same goes if you get the size of the check and it's smart money. That would be a dream scenario for me. Well, you're going to have to give up a lot of terms, as I've been talking about. Don't be surprised if the terms include different tranches, different milestones, different triggers to release certain amounts of capital. I've seen it happen before. The earlier the round, the bigger the check and smarter the money, the more those terms come into play. Don't be shocked. Hate the game, not the player. Manage it. Be prepared, visualize it, handle your emotions, and build relationships with those investors so that it doesn't fall apart on you later on. Because if you've given up terms such as control and later on you have falling out with your investors, it looks bad for everybody else and you're in for a world of hurt because it really sucks when the investors are looking at you sideways. Trust me, been there, done that, have the therapy bills and the emotional scars to prove it. Emotional damage? Oh yeah, that's me. I've got a lot of stories and I'll continue to share them on my channel. Make sure you subscribe, hit that notification bell, and you can get the front row seat for all of that coming in the future. And finally, absolutely, there is a world where you can get the terms that you want and the money smart, but the check is probably going to be a lot smaller. And that's okay. Use that investor to get other investors. You have to start somewhere. I always say, get the first pickle out of the jar and you will be okay. Now, if you're thinking, how do I even go find these investors? That's what the next video on the screen is for. It also includes a demo of an AI that I've been training to help you find investors. All you have to do is upload your pitch deck and see what happens. Go check it out.